If you follow real estate headlines in Toronto, you'd think prices only move because of interest rates, government policies, or whatever the latest news cycle is. But real estate prices don't move randomly, and they don't move because of one single thing. I'm Anthony Malfera, Toronto-based real estate broker, and today I want to walk you through the 7 fundamental forces that actually drive real estate values in the GTA. Now, this framework is based on decades of real data, not opinions, and it helps explain why prices rise, why they stall, and why long-term real estate in Toronto has behaved the way it has. Whether you're buying, selling, investing, or just trying to make sense of the market, understanding these 7 factors will give you clarity most people never get. And this is based on a combined research between Urbanation and LePage signature. Now, over the last 45 years, average GTA home prices have increased by roughly 6% per year. And they've gone up almost 80% of the time. There have been a number of downturns, corrections, and periods of volatility, but the long-term trend has been pretty consistent. The reason is simple. Prices are driven by fundamentals, not headlines. The report I'm breaking down identifies 7 macro factors that dictate demand and supply at regional level, not individual neighborhoods or specific properties, but the big forces underneath everything. Fact number 1 is population growth. The most important long-term driver of real estate prices in the GTA is population growth. Housing exists because people need somewhere to live, and in Toronto, population growth is overwhelmingly driven by immigration. For the past 25 years, the GTA has grown by over 100,000 people per year on average. About 1/3 of new immigrants buy a home within the first 5 years. And that number rises to roughly 65% within 10 years. Over time, this creates sustained demand. The data shows that for every 100,000 person increase in population, average GTA home prices have risen by roughly $40,000. This isn't immediate. Immigrants rent first, but it's one of the strongest long-term price drivers we have. So population growth doesn't spike prices overnight, but it quietly pushes prices higher year after year. Factor 2 is economic conditions. The second major driver is the economy, specifically jobs, income, and job security. Over the long run, Canada's economy grows at about 2% per year, and historically, that's been associated with 6% annual home price growth in the GTA. What's interesting is that real estate often performs well during recessions because interest rates usually fall. In the last 45 years, there were only 4 major recessions, and only one in 1991 coincided with a meaningful housing price decline. Employment matters even more than GDP. When people feel secure in their jobs, they hold on to their homes. Low unemployment has kept mortgage arrears extremely low, typically around 0.2%, which limits forced selling and supports prices. So strong employment equals fewer forced sales, which equals price stability. Factor 3, ownership affordability. This is where most people focus, and for good reason. Affordability is driven by prices, income, and interest rates, but the most accurate metric isn't price to income, it's mortgage payment to income. We buy mortgage payments here. Historically, when mortgage payments consumed about 30 to 35% of income, sales were strong and prices grew steadily. When the ratio pushed above 50%, sales collapsed, like in 1990 and again in 2023. Interest rates matter, but changes in interest rates matter even more. Over the past 25 years, every 0.75% drop in rates increased prices by roughly 6 to 7%. As rates stabilize or decline, affordability improves and demand returns. So affordability doesn't kill markets, it delays them. Factor 4, investor activity. Investors play a massive role in GTA housing, especially condos. At peak levels, investors represent 25% of all buyers and now own over 40% of all condos in the GTA. When investment economics make sense, positive cash flow, reasonable pre-sale premiums, investors add demand and supply. Recently, higher mortgage rates and large pre-sale premiums have pushed investors to the sidelines. And that's caused condo sales to fall to 30-year lows, which means less supply coming in the future, even if prices feel soft today. So when investors pull back, future supply drops, and that's going to matter later on. Number 5, replacement cost. Replacement cost is one of the least talked about and most important price supports. So to put it simply, if it costs more to build a home than what homes are selling for, developers stop building, and we're seeing that right now. In Toronto, construction costs, fees, taxes, and financing have exploded. Today, many new condos cost more to build than they can be sold for, which has completely stalled new projects. The replacement cost creates a floor under prices, even if the markets are slower. So if it can't be built profitably, supply is going to dry up. Factor 6, housing supply. Supply is the other half of the equation, and the GTA is structurally supply constrained. We're surrounded by the Greenbelt, zoning is restrictive, and housing starts have averaged under 40,000 units per year for 25 years. Meanwhile, population growth requires 50,000 plus units per year. On top of that, the housing types have shifted dramatically. Detached homes now make up about 12% of new supply, down from nearly 50% 20 years ago, which is why detached prices have far outpaced condo prices. So we didn't stop building, we just stopped building enough of the right product. Factor 7, consumer confidence and regulations. So the final factor is confidence, and this one drives short-term swings in the market. When people feel uncertain, they pause. Consumer confidence today is at one of its lowest levels in 20 years, which explains slower activity despite improving fundamentals. Government policies matter, but historically their impact has been temporary. Markets adjust, confidence eventually returns. So confidence affects timing, not really long-term direction. When you step back and look at the full picture, Toronto real estate isn't random, it's structural. Short-term noise comes and goes, but population growth, supply constraints, replacement costs, and long-term economics continue to support values. If you want more clear, data-driven insights like this, and not hype, make sure you like this video and subscribe. Thank you for watching, and I'll see you in the next one.